Good morning, everybody, and a warm welcome to the Insurance Europe webinar, Solvency II Review, the EC, the European Commission consulting the industry. I would really like to thank you all for making it at this early hour and of all topics to discuss Solvency II. It is, of course, the framework that underpins our industry. And as you know, at Insurance Europe, we have been always very vocal in our support for the system. We believe it has proved its value. And certainly since it was applied first in 2016. It gives me a huge pleasure to learn that we have more than 560 people joining us this morning. So I hope you will also use the opportunity to benefit from the insights that are provided and use also the question and answer session later actively. As Insurance Europe, as you know, we welcome the current review of the framework. We believe it is a key opportunity for policymakers to deliver on the important objectives that are set out in the Green Deal, also in the Capital Markets Union. We also believe it provides a key opportunity for policymakers to support the next generation EU plans for a social and economic recovery of Europe. And also we believe it could help this review to support improving the global competitiveness of the European industry and to deliver on the Commission's ambition to strengthen Europe's leadership in the world. For this to happen, some changes are needed to the Solvency II framework. And while we are overall really happy and supportive of it, we believe that it is overall excessively conservative. It contains some measurement flaws, and it places excessive operational burden on companies. This all creates unnecessary costs and barriers to the provision, especially of long-term products, but also investment. Insurance Europe also therefore welcomes very much the Commission's consultation as an additional opportunity to express views. Overall, we believe that the Solvency II review should not try to achieve some artificial balance or lead to an actual increase in the overall capital requirements. Indeed, we believe strongly for certain products, a better reflection of their real risk should lead to a justified reduction in capital requirements. I will obviously leave the detail to the panel debate, and this is why we are so delighted at Insurance Europe to have this opportunity now to discuss with the Commission the changes needed for the review. And in today's discussion, which is kindly moderated by Didier Millereau, who is the head of the Commission's Insurance and Occupational Pensions Unit. There is ample opportunity to do this. I would also like to briefly introduce our further panelists. We have Alban de Maynel, the Chief Risk Officer and Investment Officer of France AXA Group, and also the Chair of Insurance Europe's Economics and Finance Committee. We furthermore have Sarah Rössler, a member of the management board of the German insurance group Coburg. She's also vice chair of the Insurance Europe's Solvency II working group. And last but not least, my colleague Olaf Jones, Deputy Director General of Insurance Europe. Please, during the debate, start already submitting your questions that then can be addressed at the end of the initial panel debate. And now it gives me great pleasure to hand over to Didier Millereau for leading the further proceedings. Thank you very much and all the best.
Thank you, Michaela. Can you all hear me? Okay.
Perfect.
Good morning, everybody. I'm very pleased to be here today in a rather unusual capacity for me, which is the capacity of a moderator of a panel. For once, I will not answer the question, but pose them, which is good because it's also very timely. As Michaela said, the Commission is in a consultation phase, so it's more than natural that we are able today, that I am able today to engage with three highly distinguished panelists to discuss the content of the future Solvency II review. So I will have in this panel this morning Alban de Mailly from AXA and Sarah Rosler from Hübner, indeed, and Olaf. We have prepared for you a number of questions. I would say we will start with the more general topics, and we will get progressively into more, let's say, details and substance of the potential elements of the review. But let's start, as I said, with the more, let's say, general and fundamental questions, starting with the objectives of the Solvency II framework. And I will ask that question to Alban. Alban, what are your views regarding the core objectives of the Solvency II framework? Do you think that the review is a moment for updating them?
So, thank you, Didier, for this question, and good morning. Good morning, all. So when Solvency II, the framework, was conceived and created, the two main objectives were consumer protection and financial stability. And I believe those two are extremely valid and need to be reflected in the framework. That being said, with the benefit of hindsight that we now have, I think there are probably two other objectives that could be better reflected in the framework, which are the fact that I believe Solvency II should better support the industry's ability to do its long-term business, and I'll come back to that. And the second one is the necessity to have a competitive insurance industry in Europe. So if I start with the first one, I believe we all recognize that we have low interest rates, and that's probably there to stay. And these days, given the current crisis, we have some volatility. But at the same time, we have very strong demand from our customers for long-term products, long-term savings, long-term protection. And we also need to be able to have long-term investments, obviously to have the proper asset and liability management for those products, but also to help finance the European recovery and also finance the transition to a greener economy. So I believe it is extremely important that the framework recognizes those aspects and therefore supports the ability of insurers to provide those long-term products and invest in those long-term assets. So that's one. The second one is on competitiveness. I think we all recognize that Solvency II is probably the most sophisticated regulatory framework across the globe. It is risk-based, it is economic, and therefore the insurance industry supports that framework. That being said, given some measurement flaws or some parameters that are ill-calibrated, as Michaela said in her introduction, the framework is probably over-conservative in a number of areas. And that, as such, hinders the competitiveness of the European insurance industry, obviously, in its development outside Europe. And that needs to be also changed, because if we want to have a thriving insurance industry, it needs to be competitive worldwide. I would add another idea, which is that obviously consumer protection is absolutely essential. But consumer protection means additional capital requirements. And we must understand that at some point, if capital requirements are excessive, it is at the expense of insurance prices, and therefore it's detrimental to our customers because they need to be able to afford the insurance policies, and we need to be able to put on the market products that are competitive price-wise, especially, as I said, as we have strong demand for insurance products, long-term savings, but also some aspects that the crisis highlighted. So we need to strike a right balance between capital requirements to achieve consumer protection, but not excessive ones, so that our products are at the right price.
Okay, thank you very much. Olaf, I think Alban already kind of hinted to the issue, but more specifically, how do you think that, what, in your view, what should be the objectives of the review, and how should these interact with the objectives of the framework which Alban just recalled?
Thank you, Didier. Well, I think it's important to note that the objectives of the review can and in fact should be quite different from the objectives of the actual framework. And that's because the review does not need to include objectives on issues which are already working well and under control. So, for example, Solvency II is already ensuring customers are very well protected. And so the customer protection element does not need to be part of the review because it's working well. And in fact, it's worth noting that Solvency II was never developed because there was a particular problem with solvency or customer protection. It was developed because the policymakers and the industry wanted a system which was aligned to good risk management. And so that's very much what we want to maintain. Now, if we look at the areas of the review which are not working so well, and I think this has already been mentioned, I think there are some barriers to offering long-term products. There are some barriers to long-term investment, and those can create obstacles to the insurers providing the right balance of products to their customers, but also, very importantly, from contributing to the Green Deal and contributing, for example, to the Capital Markets Union. And I think these should be one of the key focuses of the review. And if we take one of those objectives and we look at, for example, an objective to facilitate long-term products and long-term guarantees, maybe just zoom in and sort of just think a bit about why these are important to fix and why they support the objectives of the review. So first of all, long-term products are very valuable to customers. So it's to their benefit for the industry to be able to continue to provide them. In fact, a recent pension survey that we undertook, interviewing 10,000 citizens across 10 countries in Europe, found that it confirmed a strong appetite for safety and guarantees. In fact, the highest priority for those interviewed was the security of their money, with 60% of the respondents highlighting that as the highest priority. The respondents also overwhelmingly chose investment safety, in fact, over performance, with 73%. And information about guarantees was deemed the most important piece of information. So we see there is an interest and demand in those sort of products. But secondly, the long-term products and guaranteed products actually are the reason why we have a need and ability to invest long-term. And also invest in illiquid and volatile assets. And these include the key type of assets that's just been mentioned in terms of the assets that will support the European Green Deal, the assets that will support Capital Markets Union, infrastructure assets, sustainable investment, private debt, equity, SME investment, etc. So keeping the long-term business is also core to our ability to invest, both for our customers, but for the wider economy. I think third, the long-term products also help us as an industry to avoid pro-cyclicality. So in a crisis, when others may have to sell assets, we're able to take a long-term view, ride out the storm, so to say, and this helps insurers to continue as an industry which reduces rather than increases systemic risk. And fourthly, these products help us address the wider challenges of European society. And this includes, for example, the aging of society and the strained national budgets. And of course, this will become even more important, I think, post-COVID. I think these objectives to do with long-term products, the Green Deal, contributing Capital Markets Union, these objectives are also linked because the solutions that we need to look at in terms of improving Solvency II are also very similar, and they revolve around making sure that Solvency II reflects the long-term nature of the business, is calibrated correctly, and there are a number of flaws and measurement flaws that we need to address. And if we address those, it will help us achieve all those objectives. And I think that's one area that we think the objectives should focus on. I think Sarah may want to add something on that.
Sarah, do you want to supplement what Olaf just said?
Yeah, I would like to. Actually, just to add on the importance of the products for our customers, some figures from the German market. We have in 2019, we had 99 billion of premium income in long-term products with guarantees, and so it's an important part for the German insurance industry. And our products have time spans over up to 80 years. So it is very, very important that we have the possibility to invest long-term and to do long-term business. And I think Solvency II has brought major changes, and the industry has adapted very well so far. So now we need a stable environment, and we need a stable environment to just do as we have done in the past and invest long term. And one other aspect I would like to highlight, I think that should be a focus of the review, is to reduce unnecessary burdens and to really show that we can make proportionality work, and that we reduce the burdens of reporting where they're not meaningful to the customer or to the supervisor. That would be another aspect I would like to highlight here.
Thank you, Sarah. If you allow me to dig a little bit into this topic of proportionality, Alban rightly mentioned the fact that we have a very sophisticated framework, largely recognized as being of high quality, but often sophistication comes with complexity. So we have in the Solvency II framework, let's say, the proportionality principle as one of the governing principles of the framework. It's embedded. There's a provision in there's an article in the directive which is there. But do you think that this proportionality principle works in practice? Is it operationalized enough? And if your answer to that question is not so positive, so what do you think could be done to improve the way this proportionality principle is currently applied?
Well, unfortunately, proportionality does not really work in practice. It is a very good idea, but it is, as you say, very hard to operationalize. Also, we don't have very reliable data on the whole of the European Union community to say how does it actually work, because there are no data that are collected everywhere. We can say for the German market, we had some research done in 2018 that it was really not used very much. For example, there is the possibility to combine two key functions, and only 19 companies had a combination of these two key functions. So we see that really in practice, it doesn't work very well. So what we suggest is actually to not only make it possible for the supervisor to apply proportionality, but to make it an obligation. And there could be a very simple way of doing that by saying the burden of proof that proportionality should be applied should not be with the company, but it should be with the supervisor. By that way, there would be, we would have a very strong signal, and the discussions would turn around, because there is the assumption that proportionality based on a certain risk profile has to be applied. And what would be the prerequisites? We think we should create a toolbox where we have, based on the risk profile, we have certain areas and certain companies that are exempt from reporting from other measures of Solvency II. And beyond that toolbox, we need more of the supervisory dialogue to actually then talk about possibilities of proportionality, because it's not only a matter of size. There can also be big companies that have very low risk profile, but it is a question of the risk profile, and there we need a supervisory dialogue. And one thing that could apply for everyone to make it easier for everyone is to reduce the unnecessary burdens of reporting. There are two areas. There are the QRTs, the quantitative reporting templates, where we think we should only collect the data, we should only deliver the data that are really of use to the supervisors. And EIOPA has also made some suggestions here. I think there we have to be bolder and say we really only should collect what we need. And a very important thing is to reduce the quantity of the solvency reporting to the customer, the SFDR. These reports at the moment are between 80 and 120 pages, and they're really not read by the customers. In Germany, we have collected the click figures on our website in 2018, and we had 11,800 clicks, which means that if you say we have about 41 million households in Germany, 0.03% really only clicked on those reports. And we must say we know that a lot of professors and their students also clicked on the report. So whether these 0.03% really households, we don't know. So we suggest that there should be a 2-page report, and then we could give additional information in form of the QRTs to analysts and other interested parties, but have no additional narrative. That is the big difference between our suggestion and suggestions that we see from EIOPA at the moment. Their second narrative report might be introduced, or that is the suggestion, and we're not in favor of that, because that is not relevant to the customer and to the general public. We should have a short report that the customer can really grasp and that he can understand, and everything else should be only quantitative reporting. So these are basically the suggestions that we make, and we think that could really work in practice. And we also see that the supervisors are also interested in reducing the burden of reading through all that paper, but to really indulge in a meaningful discussion and with the companies. And we think that is far more sensible than having a lot of reporting burden.
Thank you, Sarah, for these very concrete suggestions. I certainly took note of them. So unless other panelists would like to add to these question or provide their point of view on that issue of proportionality, which is obviously very important, I'd like to tackle the last question of our first theme. We know we have talked about objectives of the framework, objectives of the review, but I'd like also to ask a question about the tools which the Solvency II framework has put in place, in particular tools at the disposal of the supervisors to ensure its application. So maybe a question to Alban. Alban, do you think that these tools are sufficient, or do we need more of them? Maybe in particular, I'd like to have your views as regards the potential need for additional tools in the area of macro-prudential supervision, for instance. What do you think about that?
Okay, thank you, Didier. I think the short answer is that we don't need new tools, because Solvency II is already a robust and flexible framework. I think the focus of this review should be on fixing the flaws that have been highlighted since the beginning of this discussion. And in particular, I don't believe that we need to add additional layers of regulation. Just to give you one or two examples, there is the idea that we could add additional intervention points above the SCR. We should remember that in the Solvency II framework, the real minimum capital requirement is the MCR, not the SCR. And that was implemented, that was conceived, so that as a company breaches its SCR and its solvency goes down towards the MCR, the local supervisor can require action plans and more significant action plans as the solvency ratio goes down. So we should keep that as a concept and not add additional layers, additional intervention points. To the same extent, you can hear as well the idea of counter-cyclical buffers. That's the same idea. We see that the insurance industry has resisted this current crisis well, and we don't need to add those additional layers through counter-cyclical buffers. But it's also a flexible framework because it can deal already with some systemic aspects, and notably through the Pillar 2. For instance, and on a strict proportionality basis, as Sarah said, you could implement some recovery and resolution plan within the Pillar 2 of the Solvency II framework without adding new regulations. So I think Solvency II as a whole works well. Let's tackle first the flaws that have been highlighted rather than expand the tools that are not necessary given the already conservative framework that it is.
To this from either Sarah or Olaf?
Teams which have also been involved in, there's been some discussion about whether there needs to be a standardization across Europe. And I think here again, we don't think that's necessary. Solvency II, when implemented appropriately, is already providing very high levels of customer protection, and we think sufficient protection. The focus should be ensuring that Solvency II is well designed, calibrated, and then very importantly, is actually applied in a consistent way across Europe. And also ensuring that there's appropriate cooperation and coordination across the different supervisory bodies and national bodies across to make sure that, for example, cross-border activities are also well managed. There are already insurance guarantee schemes available or existing in many countries, and they generally work very well where they're needed, and they fit into the local context and local laws. So we believe that the requirements and the structures for the insurance guarantee schemes should remain a national concern.
Okay, thank you very much. Unless Sarah would like to step in, maybe for the sake of managing our time, I will now move to the, let's say, second part of our panel. So we have addressed the issue of the objectives of both the framework and the review and the tools. Now let's become a bit more specific and address the potential role which the insurance industry can play, in contributing to the key political objectives of the time and of the EU, namely the economic recovery and the let's say the capital market union, and also the obviously what is probably the most important priority for the Commission, as our president, Mrs. von der Leyen, has mentioned several times, that is the Green Deal, the move towards a low carbon economy as soon as possible. So obviously the insurance sector has a lot of firepower, has a lot of capacity to contribute to these objectives. But more concretely, in terms of what could be done in the context of the Solvency II review, and I will ask that question first to Olaf. Yeah. What kind of changes do you think we need to introduce to ensure indeed that we have enough support for insurers' investments and enough, let's say, incentives to ensure that they contribute to these big projects as much as they can.
Yes, I think there are definitely some changes that need to be made, but maybe before we start talking about the changes and as we've discussed the flaws, I think it's worth really taking a step back and remembering that overall the Solvency II framework is working well, and the design is very sophisticated, as we mentioned, and there are many aspects about the framework that the industry very much continues to support. The three-pillar approach, the fact that the whole system is based around a series of stress tests, and that those stress tests require the companies to assess the entire balance sheet. So nothing's off balance sheet. We look at the assets, we look at the liabilities, we look at how they interact. We look at a very large range of risks. In fact, 30 risks, up to 30 different types of risks are need to be analyzed and taken into account in terms of capital. The two-level approach, the MCR, the SCR. So there's many elements around Solvency II that really need to be kept. So we're not talking about a revolutionary change, but there are some elements that do need to be improvements and some measurement flaws that need to be improved. And if we link this back to how it relates to investments, I think the ability of insurers to allocate capital and funds to investment depends on three things. It depends on the nature of their liabilities, whether they're long-term, short-term, etc., the availability of the appropriate investments and their risk-return characteristics, and the regulatory capital treatment. And Solvency II affects particularly two of those. The availability, of course, that the other aspects of the CMU plan and the work of the Commission and the member states can improve the availability of suitable assets. But in terms of Solvency II, the focus is really on the way in which liabilities are measured and the way in which capital is defined. So really, I think both of those areas need to be improved in terms of the valuation of liabilities. And that's because at the moment, there are certain aspects that can result in the exaggeration of liabilities, and that especially affects long-term liabilities. And also at the moment, the liability measurement does not work well enough to avoid artificial volatility in the overall balance sheet. The second element is the improvements in the capital measurement, and that's the SCR, and that relates to how the capital charge or the risk of investment assets are measured. So just maybe focusing for the moment on the valuation of liabilities. Now, the reason why Solvency II can exaggerate liabilities, especially long-term ones, is because of the way in which first of all, the discount rate is set, and the discount rate is made up from the risk-free curve plus an adjustment called either the volatility adjustment or the matching adjustment. Now, the matching adjustment is generally working well, but needs some refinements and which are already planned for. So I'll focus on the volatility adjustment, and I think we'll probably be talking about that in a number of the questions later on as well. But the volatility adjustment is designed to both represent the additional return insurers can and do earn above the risk-free rate, and the overall calibration at the moment is too conservative. So it underestimates the overall discount rate, which results in an overestimation of the liabilities. And it also is intended to avoid and to mitigate artificial volatility, because while the market can be very volatile, because of the insurer's assets and liabilities and the way they manage them, the insurer is not exposed to much of that volatility. And the volatility adjustment was designed in order to help avoid that. But at the moment, it doesn't work well enough, especially in periods of extreme volatility. So we need some improvements there. Another element that can really affect the valuation of liabilities is the risk margin. Now, the risk margin is not part of the amount of money we need to hold in order to make sure we can pay the customers the expected claims and all the expenses that relate to that. It's an amount that's added on top of that based on this concept of the liabilities must be transferable on a market basis. So this is an extra amount of money, but it turns out that it's much higher than I think any of us expected. In fact, it totals 190 billion across the industry, and that reduces the capacity of the industry to take risk. and we need to improve the design and calibration. And if we do that in the right way, we're convinced that will lead to a justified and needed reduction in the risk margin, which will free up capacity for investment. Now, we are, in terms of valuation of liabilities, we're somewhat worried by some of the proposals from EIOPA, because we think, based on our analysis of them, we think they will potentially make things worse rather than better. And one of those proposals is to change the way the risk-free curve is measured, and that would actually increase the risk-free curve and decrease the risk-free curve and increase liabilities even more. I mentioned there were two elements: the valuation of liabilities that needs to be looked at and improved, but also the way in which capital requirements for investments are measured. And what we need to make sure is that when we measure the risk for insurers, that we really measure the right risk. And generally, because insurers can invest long term, they're exposed not to the short-term market volatility, the sort of, one could say, so-called trading risk. They're exposed to the long-term underperformance of those assets. And that is a real risk which we have to measure, but it's quite different from the short-term volatility. And each of the different asset classes need to be looked at in order to make sure we get that right. So when we invest in bonds, corporate bonds, we need to make sure that we're measuring the risk in the right way. And there, the main measurement of risk is referred to as the spread risk. And we need to make sure that we don't exaggerate the risk. And one key way of doing that is to make sure that insurers can use something called the dynamic VA, which makes sure that only the portion of the spread risk which really applies to them is included in the capital charge. And at the moment, that applies only to internal model users. Now, that must be kept, but it should be extended also to the standard formula users. In terms of equity investment, which is a key focus for the CMU, for example, the industry has an appetite to invest in equity, but the equity charges are at the moment too high. And we welcome that there was already created a new category called long-term equity, which has a much more appropriate capital charge. But at the moment, it's almost impossible for insurers to qualify for the long-term equity category and the appropriate capital treatment. So that needs to be improved. So the criteria for qualifying for that asset category needs to be improved. And finally, property is also a key asset category. And there again, the calibration at the moment is too high, taking into account the nature of our investments and the long-term risk that we're really taking. So I think that those improvements, if we take them all together, they will make a meaningful difference. They're not revolutionary in terms of changing the framework, but they will align the measurement to our real business model and remove the barriers that exist at the moment. Now, I guess one final thing I'll mention about that is that in making these changes, we've heard from EIOPA that they've referred to aiming for a balanced outcome. I think there we feel that, first of all, that when they refer to balanced outcome, they're ignoring some of the key changes that they're also including, such as changing the capital charge for low interest rates, and overall they're not. The actual impact would actually be quite significantly increasing capital. We also think that the concept of a balanced outcome is a bit flawed, because what we really should be looking at is the underlying risks and making sure that we're really measuring the right risks. And we think if we do that in the right way, there will be an overall reduction in capital requirements, which would free up our capacity. We also think that when we look at the impact, rather than looking at any one date, we really have to look at the impact across different market situations. And so when we look at the impact of proposals, we have to consider how would they work in periods of market turbulence. And that includes not just recently, the recent turbulence we saw in March, but going right back to the big crisis in 2011 and 2009.
Thank you very much, Olaf. On this very important question, in particular from my side, I'd like to maybe hear a few words from both Sarah and Alban. I mean, if the Commission and its proposals could do, let's say, introduce one key changes to the framework that would really make a difference from your perspective in terms of your ability or appetite to, let's say, invest more in long-term assets or in green assets? What would it be? Olaf presented us with a series of changes or issues which we would need to look at, but if you could pick maybe one of them, identify one of them as being, let's say, important or determining, which of those points would you identify? Sarah, may I ask you that question first?
Yeah, thank you. Well, generally, I think there is no specific need for treating green investments because, as Olaf pointed out, we need the ability to invest long term. And I'm convinced that the volatility adjustment and the dynamic VA for all would be a good solution if we do it right. I think we will come to talk about that later. Maybe I would like to turn the question around. What is the one thing that we don't need to participate in the Green Deal? And I think that is something like a green supporting factor or brown factor. Why? I think the industry is very aware of the role they play in the Green Deal. And we stand by to really support the Green Deal as investors. We are big investors. But the Solvency II framework is so powerful and has proven to be so powerful also in the discussions within the boards because it is risk-based, because that is widely accepted. We have to manage our risk. And that's why it's so important to keep that system risk-based and not introduce factors that are not related to risk, because that will cause discussions, or that will cause that the system as such could not be as well accepted as it has been in the past. And looking at Solvency II figures in a company is an important part when we do the oversight, and is very, very important that we keep risk-based. We are big investors in green topics altogether, and I think that the Green Deal and all the reporting initiatives can also give extra burden, but there are powerful regulatory initiatives that are being done by the EC, and that is important, but we don't need something that undermines the risk-based structure of Solvency II. In Germany, for example, we know that already qualified, more than 50% of the assets that insurers hold are green assets. And there's a lot more, but it's very hard to qualify them. And I think the initiatives that target this topic, how can we prove that we are green investors, they will help us to bring that topic even further. And sustainability is also a long-term topic. So it matches very well our long-term business. And that's why, yes, we as insurers, we stand by to invest, but also we need risk-based pricing of those assets, because we're not the only investors, and also other investors will look at the risk profile and how that matches the returns that they can get. So there is the best way to foster the Green Deal is to really have risk-based pricing and also a risk-based system to measure them. Our biggest problem at the moment is that we don't find enough assets to invest in. So that is the big topic, in my opinion, to find more assets that we can contribute to the Green Deal. I hope that also answers your question.
It does, certainly. Maybe a few words from Malbon on that topic.
So your question, Didier, your question, Didier, was.
I don't hear you well anymore. I mean, is it me only?
Okay, can you hear me?
No, yes.
Okay. So your question covered two topics, Didier. One was on green investment and the other one on long-term investments, which are slightly different topics. So Sarah covered the green investments, and I can only support her answer. I completely share what she said. On long-term investments, if I were to pick one topic, because that was your question, on the current framework that should be improved, I would pick the volatility adjuster. We are long-term owners of assets, and it's very important that we have the ability to carry those assets till maturity, and that our solvency is not impacted too significantly when there is volatility in the market, and notably on spreads. And so having the volatility adjuster changed so that it absorbs more of that volatility rather than less is, for me, essential, so that insurers, as carriers of long-term business and of long-term assets, can do their job properly. So that's the one point I would focus, but that doesn't mean that the others mentioned by Olaf should not be also included in the review.
Okay. And now, I mentioned, it's kind of a provocative question, but allow me to dig into the issue of the green supporting factor, because I think, at least from a political perspective, this is going to be an important debate during the review. Sarah mentioned the fact that the framework should remain risk-based, which means that one would still need to look at the actual risk behind the investment in which the company engages. But what about the overall risk for the society, in the sense that there would not be enough contribution from the major financial actors to the financing of the green economy, because there would not be enough incentives? In other terms, is it not risky as well not to invest enough? Should we not go beyond the individual notion of risk and look at the needs of the society in general? What do you think about that approach?
Yeah.
Well, I think there is a general and a natural interest of insurers to invest in green activities, because as insurers, we also have to deal with climate change things. Well, when climate change occurs, we have more storms, we have higher risk that we then have to cover. So there is a natural interest out of the business to really look into sustainability. And that's why there have also been a lot of initiatives also by insurers already. But I think really those that borrow money, that need money, they have to look into the topic of sustainability and make it possible that they offer more. So they should be the ones that should look for incentives, but not the investor, because we need to invest in something that really brings the return that is risk appropriate, because that is also an obligation toward our customers, that they get the return that they deserve, and that they don't get a lesser return, because we also have to protect the policyholder and the customer in that respect.
Yeah. Maybe I can add something there. I think that what the concern is that if we change artificially the capital requirements just because of a green label, first of all, we're not aware of an easy way to do that. And if you do that in the wrong way, you can easily end up with asset bubbles and mispricing. And what we need is the money to flow to the good green investments, not just any green investments. And so if we leave the risk measures based on the real underlying risk and leave it to the companies to select which of those green investments are the right ones, we're going to end up with the best outcome for society and obviously for our customers. And then in terms of creating an incentive, if we, as Sarah mentioned, if we remove the barriers and take into account the huge incentive that we have naturally to invest, the huge interest from the insurance industry in those sort of investments, and we combine that with the enormous set of initiatives started by the Commission in terms of disclosures and encouraging companies and customers and everyone to look at at investments and at behavior and encourage further the investments, I think that creates a huge incentive to invest already. And after that, the biggest barrier remains the availability. And we hear of figures of 250, 300 billion investments needed each year. We have 10 trillion of assets under management. Every year we get 1 trillion of new premiums in. So we're really interested in this 200 or 300 billion of green investments that is needed, but we don't see it at the moment. And so combined with the removing of the barriers so we can invest, I think much more needs to be done also to make sure those investments come online so that our investment capacity can be used to its full.
Okay, thank you very much for these responses. So unless Alban would like to very quickly step into this discussion, I'd like to move on to let's say, the third phase of our panel today, maybe looking, as I said, a bit more now specifically into some two issues which we have approached already, but which are obviously very topical, in the current economic environment. The issue of short-term volatility and how the framework deals with that, but also let's say the low phenomenon, the fact that we're going to be facing very low, not to say sometimes negative, interest rate in the coming future and probably in the mid to long term. So, but let's start maybe with short-term volatility. We saw enormous volatility at the beginning of the COVID crisis. Market fell tremendously, then went up. Do we need to take these issues into consideration in the Solvency II review? Do we have the right tool to manage or mitigate short-term volatility? Are there flaws in a system that need to be fixed? Olaf, what are your views on this?
Yeah, I think as Alban mentioned, I think the volatility adjustment and volatility is rightfully one of the key discussion points around the Solvency II review. I think it's worth remembering that the issue of volatility was one which came up very significantly during the development of Solvency II. In fact, because of some testing that was done soon after the financial crisis and the 2008-2009 period, that actually led to a delay in Solvency II while what was called a long-term package was developed in order to better reflect the long-term nature of the business and avoid excessive volatility that we had seen in the market flowing through into the measures incorrectly, because the industry, as is shown in 2009, 2011, and more recently, we can ride through this volatility because of the nature of our assets and liabilities. So Solvency II already has, I think, all the tools it needs. It has the VA, the MA, the extrapolation of the risk-free curve. It has a number of mechanisms in terms of also recovery periods, the MCR, the SCR. So it has a variety of tools which were designed so that it could cope with the market volatility and that this wouldn't unnecessarily disrupt the businesses. However, those tools do need some improvement because they're not working well enough. And I think you mentioned the volatility we saw earlier this year triggered by the COVID crisis. And indeed, that did generate some significant volatility in the solvency ratios, especially in certain companies and especially in long-term portfolios. And that's an example where we saw it wasn't working well enough. There's also an element of the VA called the country component, which is specifically designed to make sure that the VA can work across a range of countries and situations. And we saw that country component didn't activate in the way that it was needed in order to help mitigate the volatility. So there is some improvements needed. And although we now, I think, because volatility has been relatively low in the last few years, we perceived the March volatility as being quite high, and it was high, but it was nothing like as high as the volatility we saw in 2009 and 2011, which were many times higher, I think up to 5 times higher than what we saw in March. So we need to make improvements so that it works not just during the March type volatility, but maybe even more importantly, it works during more extreme times. And if we do that, we'll have a business that it can reflect correctly the fact the insurers can ride out even very extreme market storms as those we've seen. And I think the improvements we need is to make sure that the VA works better in terms of volatility mitigation, but also is overall calibrated so that it reflects better more of the spread that the insurers can and do earn on the reference portfolios that they invest in. And I think if we do that, we will reduce those burdens. I think it's worth noting that when we look at some of the ideas that have been put forward from EIOPA, some of them are quite helpful especially in terms of improving the country component that I mentioned isn't working. But there are other elements that undermine potential improvements. In fact, we believe would make the volatility adjustment worse, not better. And that includes the proposed changes to what's called the risk correction and the introduction of a liquidity adjustment factor, which would in many cases lower the VA and introduce unnecessary complications. So I think that's one of the key areas, but there are other areas of Solvency II that can create some volatility that also need to be looked at, and maybe I'll pass over to Sarah to talk about some of those.
Yeah, there is, for example, also volatility or an increase of volatility that we fear if EIOPA comes through with suggestions to change the calculation of the risk-free rate. That can also generate volatility. At the moment, already, we are reflecting negative interest rate in the risk-free rate. But for the euro, for example, we have the last liquid point where we use market data at 20 years. And after that, the curve is extrapolated to the end. And now one of the suggestions is to move this last liquid point to a later stage, for example, 30 years. And the problem is the last liquid point carries this name because the markets are just not liquid anymore between 20 and 30 years. So in a non-liquid market, we will have distortions by when there are changes in the environment and very, very low trading, and there will be distortions to the rate, and that will create extra volatility and does not produce meaningful data for the valuation of our liability. So it is very important to keep the last liquid point where it is, because if we change it, we will generate extra volatility, and that's something that we don't need, and it will not be produce meaningful information within the companies nor for the supervisors.
And if you allow me, Didier, would add something on this. So two comments. The first one, in the framework, I think the risk margin is also a source of artificial volatility. I mean, Olaf described it as a component that is additional capital, in fact, though it's not named capital, but it's also a source of volatility because as interest rate go down, the risk margin inflates, and that is extremely procyclical, and that does not reflect an economic reality. So we need to amend this. I think the EIOPA has identified that issue and is proposing some changes, but I think we could go much further in reducing the sheer size of the risk margin and also the volatility that it creates. But that's the first comment. The second comment is different. If I may, it's on the use of Solvency II in a volatile environment, and we had. Unfortunately, a very good example of that a few months ago. We saw that the EIOPA first issued a statement highlighting the need for companies to take measures to preserve their capital position. And that was wholly appropriate given the volatile environment. But then, in the second step, the EIOPA changed and urged the NSAs to impose a blanket ban on dividends for all companies. regardless of their capital position, their risks. And we believe that though it was a volatile environment, the issuance of such a blanket ban was both unnecessary and damaging. Unnecessary because already today you have in the framework all the tools available to the boards to make the decision. When you go through an ORSA, there will be midterm and long-term capital projections and risk projections, which allow a board to determine whether the capital position of the company is at risk or not. And ultimately, it is for the board to make that decision to pay a dividend or not. So I think a blanket ban was not necessary, but it's also damaging for two reasons, at least. One is that it undermines the credibility of Solvency II. If the NSS had said to those in a more risky position or less well capitalized, don't pay a dividend, everybody would have understood it. But the fact that even those who are well capitalized got the same ban on dividends means that at some point the supervisors didn't believe in the Solvency II framework any longer. That undermines the credibility of the framework. And the second thing is that generally for listed insurers, insurance stocks are seen as value stocks and therefore need to pay dividends, and notably to pension funds and more generally to shareholders. Forbidding the payment of dividend means that the rating of the stocks will be hindered, and therefore the access to capital by insurers will also be hindered. And if we want to have a thriving insurance industry, we need to make sure that access to capital and therefore predictability of dividends is well understood and well managed in all aspects. And by issuing that blanket ban, it was damaging in that instance. So I believe there are all the aspects that we've described on the volatility of the framework, but there is also how people react in a volatile environment given the framework.
Thank you, Alban. Do you want to add anything on this before I move on maybe to another question linked to the impact of short-term volatility on the ability of the industry to continue to propose long-term products and long-term guarantees?
Well, although I myself come from a mutual company, I agree with everything that Alban said.
Okay, that's a very clear and straightforward answer. Thank you very much. So now let me move on then yet to the next question. So we indeed are into the issue of short-term volatility, and as mentioned by Olaf and others before, I mean, obviously the vocation of the insurance industry is to be able to offer a wide range of products to its customers, including long-term products, long-term saving products, and there is an appetite among the many customers to be able to have access to long-term guarantees. So maybe Olaf, do you think that really this issue of the ability of the framework to address excessive volatility, short-term volatility, is it essential in that debate, or issues which need to be addressed to really indeed allow the sector to continue to offer these products?
Well, I think it's really a package of measures. I think the volatility one gets talked about a lot because during times of crisis it really can show itself to probably be the overriding issue. But in general and during sort of more normal times, the other issues that we've talked about become more important. So I think overall we do need a package of improvements that covers the volatility issue, the exaggeration of liabilities due to the calibration of the VA, but also the risk margin. And also we need to address the capital charges for assets, bonds and property, as I mentioned. I think if we tackle those issues together so that we reflect correctly the business model and the risks of insurers, that will unleash the capacity of insurers to offer a good range of products, including guarantee and long-term, and invest in the economy that's needed. So I think it's really a package we need, not just one golden bullet.
Thank you, Olaf. Any views from other panelists on this issue?
Maybe one thing I should probably say, there are also things we shouldn't change. And I think together with the things we should change, we should remember again the point made by Sarah that we shouldn't change the way in which the risk-free curve is set, and we shouldn't be looking to change significant other parts of the Solvency II package. I think what we need is a focused set of changes, and keep Solvency II largely as it is.
On this point, Olaf, if you allow me, we are living in this low interest rate environment, and many say that this risk has not properly been taken into account by the framework. So do you really think that nothing needs to be done in this field?
Well, maybe I can touch on the part of the low interest rate issue, but then hand over to Sarah. I think it's really important to notice to recognize there are two issues when people talk about low interest rates. One is the risk-free curve for valuing liabilities, and the other one is the capital charge for the interest rate movements. And I think on the capital charge for the interest rate movements, the industry recognizes that at the moment the methodology doesn't allow for negative rates. And on that part, we agree that the methodology needs to be changed so that we do allow for negative rates, because when Solvency II was designed, this was considered not or so unlikely or temporary that it wasn't necessary to include. We have seen now that negative rates can happen. They can happen for extended periods of time. And so the methodology for the low interest rate capital charge needs to be adapted for that. I think that doesn't mean, however, that we should have an unlimited negative sort of assumption. I think the key question is how negative can rates go, and recognize that when Solvency II applies a certain rate, it effectively assumes it stays there forever. So it assumes it's not just a temporary thing; it's a permanent thing, because we value the entire balance sheet assuming this negative rate stays forever. So I think we have to bear that in mind when we calibrate the sort of floor or how negative rates can go. And I think that we think that rates can go negative, but not extremely negative. And to have them very negative would be extremely damaging to the business model. And so, for example, we think that the floor that EIOPA is proposing is far too low and negative. And we think other floors need to be considered, which would not have such a pro-cyclical and damaging effect. Also, I think there's also we have to look at the way in which the methodology is applied. Right now, EIOPA is proposing to apply the sort of shock or the application to the entire curve beyond the last liquid point. And given the way that the interest rate curve is generated in Solvency II, that we think is wrong. It should only be applied to the part up to the last liquid point. So there are we recognize that this needs to be dealt with, but we do have some different views about exactly how it should be done. But as I said, that's just part of the discussion. Maybe I'll pass over to Sarah to talk about some other parts.
Well, I can only underline what you just said. As Solvency was designed, no one really conceived the possibility that we would have negative interest rates. And now we have to acknowledge it can happen. I won't go into the details how damaging that is economically and how much it is bad for those saving money for the future. But we have to acknowledge the problem is there, and we use it for the valuation already. But now the question is, how far can a shock go down? That is really the capital charge for the interest risk. Is the question, can the shock go down very far, and how far can it go? And I think there is a natural floor So we won't. We have to acknowledge that the shock will not be indefinite to the low side, and we have to find the right floor, and we have to see to it that it's not overly conservative. And that's why the calibration that we see at the moment in the suggestions by EIOPA goes far too far. And it also only makes sense to apply that shock to rates that we actually view and not to a methodology, which is the extrapolation. So that's just underlining what Olaf just said.
Thank you. Alban, any follow-up on this?
No, I think it was extremely well described by my two co-panelists.
Okay, thank you very much. So first, let me apologize because I'm struggling at the moment with two computers at the same time. It's not easy to be a moderator in these circumstances. So thank you to our panelists. I think we have covered all the questions which we wanted to cover. Maybe before we go to the Q&A session, I see that there are quite a few questions which have been posed, and we will take a bit of time to look at these questions. Do my fellow panelists wish to add points which they believe are important for the review and which we did not have the time or the opportunity to cover so far? So before we move to the questions.
Well, just as a general remark, I would like to mention again, Olaf has mentioned it before, and Michaela has also mentioned it, that we need a balance with all the measures that are introduced by the review. As we just said, there is a need to recalibrate the interest rate risk, but we also need measures that make, that lower the capital charges so that solvency as a whole remains a balanced system, because it has proven to be a good system in the past years. So that's just a general remark in favor of that general balance that we would see as a major goal for the review.
And if I add also one comment, I think we should not lose sight of the economic role that the insurance industry needs to play in Europe, both as an investor in the long-term economy and as a sector that provides protection to the population. And we need to make sure that even if the environment is difficult economically and for sanitary reasons, we need to make sure that the insurance industry can play its role, and therefore that the framework is adapted in that direction and not in the opposite direction.
Okay.
And I think I would maybe just add that we really do need to make sure it works across all sorts of economic situations. I think we need to backtest. We need to make sure we understand the different the impacts for across the different countries as well as in aggregate. So I think that we also have to be very careful not to when we talk about a balanced approach, not to be a sort of in a way, a sort of a meaningless outcome, because if we only look at one point in time, and if we only if we exclude things from that balance, then we're not going to get the right outcome. And I think that if we recalibrate in the right way and we reflect the long-term business correctly, I think in reality we will have a reduction in capital requirements, particularly for long-term business, and that will enable us to contribute with those products and with the investment in the way I think our business model gives us capacity to do.
Okay, thank you very much. So I suggest now we move to the questions which we have received on the we're using the Q&A tool of our platform. And if you allow me, starting with maybe with a question asked by, I think it's by Yunut. It's about the crisis. I mean, during the recent crisis, there was the obvious question of the impacts on the industry and the possible need for introducing quick changes or quick fixes to the framework. This was discussed by IOPA at several stages, also with the member states, by the way. And the conclusion was that there's no such need, at least at this stage, to introduce those quick changes. So I would like to ask my fellow panelists, do you think that this is the reasonable thing to do, or do you regret it? Would you have liked some, let's say, quick adaptation? Would you have liked to see some quick adaptations to the framework in order for you to be able to better fare through the crisis?
If I start, Didier, if you allow me, yes. I would say two. The first thing is we've seen that the insurance industry has resisted that crisis quite well. And that also underlines the conservative nature of the framework, because we started from a significant capital position, and we still hold a significant capital position as an industry. So I don't think that was necessary. Second thing, we see that it is a very good framework, but it's also a complex framework. And I believe we should take time to review changes, amendments to the framework, and not act precipitously. We need to take time to do that. And so I welcome the fact that we have not changed the framework during the crisis.
Yeah,
I agree. I agree. We have been, I think the insurance industry has proven to be a stabilizing factor, especially in their role as an investor during this past crisis. But I think it's also important now that framework has worked to see, would it have worked in even a greater crisis? Olaf has pointed out that the crisis of 2008, 2009 was even produced more volatility. So we should use the data we have collected now to actually see whether the system that has worked well now and perfectly is robust enough to also cope with other crisis situations.
Mm-hmm. Yeah. Yes, I think I would echo some of those comments. I think that indeed the industry has managed very well. I think that we didn't have solvency issues. We did have practical challenges, and COVID for everyone, obviously, aside from the terrible impact it's had on many individuals' lives and health, it had a lot of practical challenges for everyone. The insurers, I think, managed well with those practical issues in terms of their preparation to go digital, to do things remotely, to work remotely, to have their teams change to remote working, work remarkably well, I think. There are some local barriers in terms of, in some countries you still can't do everything digitally, or you can't yet do everything digitally. So there are some sort of practical barriers to look at after, sort of in the aftermath. And I think that we did welcome the relaxation of some of the reporting deadlines to help enable companies to focus on their customers rather than some of the regulatory reporting requirements, and that was possible within the existing framework. So that showed again that Solvency II allows for some flexibility. I think one of the key reasons we want these improvements is to make sure that we don't have to step in a sort of emergency way to change things that aren't working in a crisis. And if we make the changes that we're talking about, I think Solvency II will be really sort of finished in every sense of the word, a very comprehensive system that works well in all periods of time. I think if we had seen a lot more volatility closer to what we had seen in 2009 and 2011, then it's possible that some action may have been needed. And I think that, like everything, one has to remain vigilant. But I think we did the right thing by not taking action in this case. We coped very well. And that we hope that these changes that we are talking about for Solvency II, they will go through as fast as possible, although we know that it will take a few years. But as Alban said, that gives us the time to make sure we get it right this time. And that will prepare us well for any future crisis.
Thank you very much. Now let's move to another question now related to the issue of proportionality, and particularly the point made by Sarah, I think. about the let's say the ideas which are being developed in terms of better operationalizing the proportionality principle. So, Sarah, you mentioned the issue of the transfer of the burden of proof. How do you see this happening? Do you think that the supervisors have the capacities throughout the single market to deal with, let's say, more frequent interactions with the insurers under their jurisdictions? And are you happy with the ideas which are currently being developed at IOPA, indeed, to make that proportionality principle, let's say, more practical and more efficient and effective in reality?
Well, I think the matter of capacity really goes together with the matter of how do we deal with proportionality. I think at the moment, IOPA's initiatives are not concrete enough to really suggest a system of proportionality that will exempt a great number of companies from unnecessary burdens. Because it was really the goal to exempt about 20% of the companies, but that in practice doesn't happen. So if we find concrete criteria to exempt people or companies from the reporting burdens and from other burdens that they have through Solvency II, and we say there is an assumption that prima facie, there is the assumption that when you meet these criteria, you don't have to prove that you do, but you are exempt. Then the supervisors will also gain time to really care about the important issues. And I think it is important to have a good supervisory dialogue, to talk with the supervisor about the risk profile and about the strategic issues that a company has. We have a very fruitful dialogue with our supervisor, and I think that is helpful for all sides. But I also acknowledge that supervisors need time to talk about maybe more complicated matters, and the easy matters, they should not have to be reported. And that's why proportionality is a win-win situation for the companies, but also for the supervisor.
Okay, thank you very much. Now there's a question to Alban. Let's move on to the capacity of the industry to, provide, offer long-term guarantees and long-term saving products. So the question is the following: Do you think that if the Solvency II framework is appropriately amended, do you really think it will make a significant difference in terms of the ability of the sector to propose those products? Or are we not, let's say, overall, under the influence of the global economic environment, which could make that offer at the end of the day still very difficult to make? What are your views on this?
It's a very good question, because the first thing that we need to recognize is that the economic environment, and notably the interest rates environment, doesn't make it easy for any insurers to propose guaranteed investments. When you have the bond rates where they are today, being able to remunerate the customer, the distributor, and the shareholder is not easy. So what can be done? What can be done is providing products where you probably guarantee capital, and perhaps a little more than that, in the long term, 10, 15 years, but not year after year, which allows you to take some more diversified asset portfolio to both obviously comply with that guarantee, but also offer some additional return to your customer. But you need to have that diversified portfolio and to have long-term assets. And that's why we mentioned a few times during this conversation the need to have the proper capital requirements for that kind of assets. But I fundamentally agree with the person who asked the question. We need to adapt to the current environment, and not all products, and not in particular products with annual guarantees, are possible today.
Okay, thank you. I'm checking the questions. There is a question on the global competitiveness of the industry, and in particular, let's say, in view of the departure of the UK from the EU. So I shall not comment, nor the question, nor the possible answer, but I'd like to nevertheless hear the views of our panelists on that. So should we worry about the UK's departure, and what does it mean in terms of possible issues of competitiveness for the EU industry?
Well, maybe I can take that. I think I think that we've been working very closely with our British colleagues for many years, and they've been involved in Solvency II from the beginning. In fact, some of the ideas came in fact from the regulatory system as it was within the UK. So I think that we've all been seeking the same changes and improvements, and I think they revolve around the risk margin, the VA, and the capital charges. And I think that we will see that within the UK, they will be seeking similar changes that we have and improvements that we've been talking about here, because they have basically a similar market and facing the same challenges in terms of making sure they can continue offer the range of products and invest. I think the matching adjustment is one area which has a relatively higher importance in the UK because of the nature of their business and annuities, for example. So I think there may be some detail around that may be slightly more of a focus than for us. But we are also pushing for some changes and refinements to the matching adjustment. So I think largely we have the same business models and the same challenges, and we are seeking the same improvements to Solvency II.
And I think you wanted to step into on this question as well.
No, I agree with Olaf. I think very much as he said, we've always had our British colleagues alongside us on Solvency II, and they brought a lot of good ideas. I think we see the purpose and the nature of that regulation in the same way. And the only thing I would add is that insurance is still very much a national industry, and therefore, if a continental European insurer goes to the UK, he will need to comply with the UK regulation, and I think, and obviously vice versa, and I think that is okay, and that will ensure that we have relatively similar regulations in the future.
Thank you. I think we still have a little bit of time, so there are a few questions left. There is a question about governance. So I guess the question is, we have spoken a lot about capital requirement, how to deal with volatility, long-term investment, but what about the way the insurance sector manages itself, manages its risk, is organized? Solvency II has obviously introduced some significant changes in improvement in this respect. Do you see any need for the coming review to look at these issues, to look at the way ORSA are being carried out, for instance, or are we fine with what we have?
Well, maybe I try to start with an answer. I think, as Olaf said, we should not change things that work in general. And I think governance works. There are some things which I find a little burdensome, and we should see to it that there are no more key functions, no more roles defined. And certainly there's also a big heap of documentation that has to be done in the companies. And I think that's not a key area. I think in general, we can say governance works. And so I don't see a major need for change here.
Yeah, I would very much echo that. I think that the Solvency II, one of the innovations, although the bank in Basel, they have 3 pillars which look very similar to Solvency II. I think Solvency II sort of filled the pillar 2 and 3 with, especially pillar 2, with a lot more content and detail than I think any regime before it. And I think that the main challenge is, and I think it works very well, and I think the industry was very supportive of having a very strong pillar 2 that set very high standards for internal risk management, for governance, and that was generally aligned to what many companies and most companies were doing already, but made sure that everyone was living up and applying those high standards. So I think the challenge is not to certainly not to add more. The challenge is really rather to get the proportionality working, as Sarah discussed earlier, so that those very extensive governance and other requirements can be sort of adapted to the size and the complexity and the materiality for each company in a reasonable way. So the risk protection is maintained, but in an efficient way.
Okay, thank you. Very specific question on the volatility adjustment technique. So we have 2 instruments, a volatility adjustment and a matching adjustment. So there is a question about whether there is any potential for extended the use of the matching adjustment, which, as we know and as you recalled, Olaf, is only used in very specific markets at the moment.
Yeah, and over the years and
system. Yes, Olaf, please. Hello?
We may have lost Olaf.
We may have lost Olaf, so it's not me. Alban, do you want to maybe address that question?
Sorry, because as we lost Olaf, I also lost the question.
No, it was about, should we have a bigger use of the matching adjustment? And if so, maybe what are the changes that should be introduced to ensure that? Or is it not relevant? I mean, it may not be relevant for some markets, of course. No?
I think I would put it the other way around. If we have a proper volatility adjustment, one that reduces volatility, as I mentioned, and as Olaf mentioned earlier, I don't think we need to enhance the use of the matching adjustment, which is, for the time being, limited because of certain criteria to use it. I think a good volatility adjustment is better because it's more flexible and reflects also the reality of our portfolios.
Mm-hmm.
Maybe there is slightly a deviation to your Alban's answer. I think also it was intended that there are 2 instruments, the volatility adjustment and the matching adjustment. And it is a pity that the matching adjustment isn't used in a lot of markets. From my point of view, because it's too complicated to allocate the portfolios to the, so it is very complicated, and it leads to the fact that you're not very flexible anymore in your investment strategy. So I think, yes, it is worthwhile also thinking of the matching adjustment, but I agree, and that's why there's only a slight deviation, that the bigger need for change seems to be in the volatility.
Okay, thank you. Maybe 2 questions, and then under the control of Olaf and Michaela, we could maybe wrap this up. I've got this in my face. Let's go back maybe to issues related to insurance capacity to invest. So there was a question about, the fact that for many insurers, the main source of or the main target of investments are, let's say, sovereign bonds or corporate bonds. So the question is, do you think that really there is a chance to introduce adjustments to the framework which will allow insurers to further diversify their portfolio and therefore maybe participate even more to, again, the objective, for instance, of the Capital Market Union, which is to increase the financing of the real economy. So maybe Alban and then Sarah on this.
So I think the first thing that we should recognize is that what's driving an asset allocation should not be primarily the capital framework, but should be the nature of the policies that are sold to the policyholders. And if you have very strict guarantees, notably on the savings side, you have to invest first in fixed income assets, such as corporate or government bonds. But that's why I said earlier that we should allow for other types of products that give only long-term guarantees and not annual ones, because then you have the ability to have a more diversified portfolio, which can go into private equity, infrastructure, which do finance the economy and notably the European recovery. But we need to have a framework, and then it comes to capital requirement, that recognizes that long-term products with only long-term guarantees do not have the same capital requirements as very strict annual capital guarantees product. And we need also the support of that capital framework to make sure that investments in long-term private equity funds, in long-term infrastructure, is not penalized, but rather supported by the capital framework.
Thank you. Sarah, do you want to add?
Well, I think Olaf has mentioned it before. There's one concrete example, which is property. The risk of property is, in our opinion, not calibrated realistically. So there should be a lesser risk factor for property investment.
Okay. Okay, and then maybe a last question. It can be a technical subject, but the question was asked, so I think it's probably worth addressing it. It's related to accounting. So we know at the Commission that there is a lot of concerns expressed, at least in some part of the EU, regarding the possible adoption of the IFRS 17 standard. So I'd like to hear the views of the panelists on the topic. Do you think the EU should endorse it, or should we amend it to make it more, let's say, adapted to our needs? Any views on that? Very specific, but let's say important subject.
Yeah, I think, well, this is a bit off topic, as this is a Solvency II webinar, but I think the general comment is, and that I would say is that that just like Solvency II, it's important that the accounting rules do reflect the realities of the insurance business model, and we've had a long sort of journey towards the end of IFRS 17 and indeed IFRS 9 in order to make sure that these very important accounting standards do reflect the insurance business model. And there have been some important improvements along the way. I think that the outcome that the ISB has landed on has addressed some of the issues raised, but not all of them, and there's some disappointment there. But I think the main area of discussion is really around the issue of of what is referred to as annual cohorts, where this was one of the sort of joint issues of the industry. And there's still some discussions going on in Europe about whether or not it's possible to address this final issue, which I think is the last big concern. But I think there is a general keenness to finally finalize IFRS 17 in the right way. And there's a process going on with the advisors, EFRAG, who have given their draft advice, and the industry will be looking at that intently and developing its views over the coming weeks and months.
Thank you, Olaf. I think it's worth taking a last question, which I just received and is indeed, in my view, linked to Solvency II. It deals with the issue of the quality and of the supervision and the potential need for increasing the coordination or the cooperation between the different competent authorities in the EU. I think I heard you saying that, Olaf, that your views on this are that the system works more or less okay. But nevertheless, do you think that there is a need or potential for further enhancing that cooperation, that, let's say, convergence of supervisory practices in the EU? And do you think maybe in the longer term, because we know, especially from my perspective, that it is difficult, that there is a possibility or potential or need for increasing the power of our European authority, namely EIOPA?
No, I think generally we think that EIOPA has the necessary tools. And I think that if you look at where we've come from, I mean, 10 years ago, Europe had, and the insurance industry had relatively little harmonized regulation across Europe. We didn't have Solvency II, IDD, the GDPR, the PRIPS, etc. We had relatively little, and now we have a very extensive common rule book covering all aspects of our activities. And I think that some of those have been, Solvency II was introduced in 2016, some of the other ones have come later. And so I think we are in the process of moving towards significant convergence. And with Solvency II, a huge amount of convergence has already been achieved. So we obviously have more to do. We think EIOPA has the tools to do that. I think the one area where we have acknowledged and actually supported some further powers in the ESA review, for example, was to make sure that the cross-border activity, that it really is coordinated as well as it needs to be and works as it must in terms of ensuring that Solvency II is applied, that customer protection is equivalent across the different countries, and that the supervisors do coordinate and their activities in terms of oversight of cross-border business. And I think that was the one area where we have supported more powers, and I think EIOPA have proposed some small changes there that we would support as well. But I think beyond that, we really feel that the powers they have already are appropriate and can be used effectively to achieve the harmonization that Europe wants and needs.
And I would add that the current system combines both proximity and consistency. Proximity because you still have your local lead supervisor with which you have frequent talks, and consistency through the College of Supervisors. And being the representative of an international group, I can tell you that the state of the group is very much discussed among that College of Supervisors for all the countries that we're in. And that achieves a consistent view on the group from all our supervisors.
Yeah, I would underline that. I think it's very important to have the national supervisory authorities really going into the dialogue and to work on convergence as it has been in the past. And I think great progress has been made, but it is important to have that proximity, as Alban put it.
Okay. I think we have covered more or less the questions. Apologies if I overlooked some of them, but I've also tried to regroup some themes in order to organize our conversation. I see that there are questions about the timing of the review, and maybe it could be a way for me also to wrap up this panel under the control of Olaf, of course. As you know, because of the crisis, we agreed, we discussed and agreed with IOPA that we would postpone the timing of the Solvency II review by 6 months. So instead of presenting their advice to us in June, IOPA will do it in December, which means that automatically and mechanically that we at the Commission level would present our proposals not by the end of this year as was originally envisaged, but later during the summer of 2021. So we thought it was the most reasonable thing to do, and first to allow us to take into account the effect of the crisis, but second also to be able to further engage with stakeholders, and this is why we have in particular launched our open public consultation, which is still running at the moment until the 21st of October. So we're very much looking forward to the contributions which the different stakeholders may wish to present to us on that. And then, of course, once the Commission adopts its proposal sometime during the summer next year, we will have the normal legislative process to follow, to amend the level 1 directive, but also most probably to introduce changes to the level 2 delegated regulation as well. We still need to see how we can synchronize the two exercises, but the review will probably impose that we look at both, let's say, pieces of legislation. So, Olaf, if that is okay for you, unless there are any really pressing questions, I think we can call it a panel. Okay. I think there was a need to follow up on your answer on matching adjustment. I guess you can do that bilaterally with the colleague who did not manage to hear your answer. Olaf, can I give the floor back to you?
Yes. Thank you very much, Didier. And thank you for our other panelists, Sarah and Alban, and Michaela's introduction, and thanks for all of you who logged in to listen and provide questions. And I think with that we can close the event. Thank you very much.
Thank you.
Thank you very much.